Hello, I'm Joel. I'm the Chief Market Technician here at TheMarketLadder, and today we're going to talk about a one-year performance review. First, there's a risk disclaimer. I am not a financial advisor. Investing in the stock market is inherently dangerous, so please take any trades at your own risk. Thank you. All right, so here's the MarketLadder performance for last year. We had 72 wins, 47 losses, with the average win percent was 13.1%, and the average loss was 7.6%. So what that means is that the average win percent for the winning trades was 13.1%, and the average loss for the losing trades was 7.6%. What we like to see is that this number, the average win is about 2 times the average loss, and we were close to that, but we didn't quite get there. But what we did have is a quite more wins than losses, so that really helped us out on the overall profitability. And so that ended up with 46% in 1 year, which is very good. We did have a max drawdown of 7% within that year, so that meant that if you were taking every trade and that when they started to go down, your from peak to trough, the maximum drawdown was 7%, which isn't bad, but hopefully that fits within your risk appetite. If you weren't able to stomach that much, you could take smaller sizes, but then you would also limit your upside as well. Something to consider. All right, so as these were good gains, but want to point out what these gains do not include, and the biggest thing is the potential taxes. So if you're trading those within a general trading account, then you have to pay taxes on your wins. And so that if you made 46%, at the end of the year, Uncle Sam is going to come by and say, hey, you made 46%. Wouldn't you like to share those with me? And you're going to say, why, yes, I would like to share those with you. So that's the main consideration. If you're able to trade those or trade within a retirement account, you don't have to pay taxes as long as you keep those funds within the retirement account. So that's the best way to do it if you're able to do it that way. The next thing is broker fees, and most brokers, such as Fidelity, are ETF commission free nowadays. That's usually not even a consideration. And then the last thing is slippages, and that's rare for our ETFs because I trade the largest and most liquid, well-known ETFs. And what slippages mean, if you're not sure about that, is that just means if you're trying to sell an ETF, sell a stock, and let's say you're trying to get out at $50, but it doesn't sell till $46 because there's no buyers. There's not enough buyers to fulfill your order. Well, then they have to fill it at a worse price. But again, that's very rare, and to this point in time, there's been nobody that let me know of any slippages that have occurred for them with their trades. And then there's just a couple of little notes here at the very bottom, and one is that somebody may be asking, well, hey, what about ETF expense ratios? I've heard about those. Well, those are already built into the mix, so you don't have to worry about those. And they're also relatively small for the type of trading we're doing, so you don't have to worry about those. And then the very last thing, just to reiterate, past performance is certainly no guarantee of future performance. But all in all, those were solid performance metrics, and I'm happy with that. So here's just is the same data. It's just showing to you in a different way. So we talked about average win, average loss, and then this is the win-loss ratio with some more metrics here going across the top. Again, this is just a different way of showing you the same information, and this shows you the profit and losses that we had over time with the trades going from left to right. And then this is really the most important thing I want to show you is the equity curve. So if you placed every trade within your account and you followed along, whether you're trading more or less than I am, your equity curve is going to end up looking the same. And so we ended up, again, getting just over 45% for the year, 46%. We did have a couple bobbles here. And then we had, this is the max downturn that we had. So we talked about that being about 7% from here to here was about 7%. So that's it. I wanted to show you what we did, and I'm pleased with those results. So my performance goal is to get 50% every year. So we almost got that. Didn't quite get that. and then with a max drawdown of no more than 8% during that year. So that's a goal I keep for myself, but I do that to get to inspire me to get the most that I can for all my subscribers. Of course, it's not a guarantee, but with a lot of due diligence on my part and a little bit of luck, I believe I can get there. All right, so what would be the potential obstacles then to getting either my goal or getting a repeat performance like we did last year? One would be a bear market and or increased market volatility. They usually go hand in hand. Bear markets, I do think will still be profitable in a bear market, and that just means that the market, when I say bear market, that means that the market is losing money. The market's going down in value. But I believe it will still make money, and it's just harder because we can place trades that make money when things go down. They're just harder to time, and they're harder to know when to get in and out of those trades. So that's why they're more difficult. And then the next thing on that list is knucklehead trades. And you're like, what is knucklehead trades? That's just when I get into a trade and I've missed something that I should have seen, and or I fall in love with the trade and then I let myself take more losses than I should with that trade. So those are called knucklehead trades. I am human. I will have a knuckleheaded trade occasionally, but I will keep those to a minimum. I promise. Okay, so those were the potential obstacles. Those are the only things I could see that would hurt us for future performances. The next thing is that how could we actually do better in future? And one is that compound interest magic. I've got a video on that. If you haven't seen that already, I would check that out. But that just means that when you have gains and you have multiple trades in a row that were profitable, now all of a sudden you've got a little bit more money into your trading account, so you can start placing bigger trades in the future, and you can use you did use that money for future trades, and that creates a snowball effect. So that's what we call compound interest magic. And then the last thing is on this, it says some ETFs will pay dividends. So that's kind of a cherry on top. I never include that. I don't trade because ETFs offer dividends, but sometimes you just get into an ETF that does pay dividends, and you'll see after you've sold out of that ETF that you'll have a couple $100 as well. So that's just a nice cherry on top. Okay, so in summary, last year we did 46%, which is good. I'm hoping to maintain that or even do slightly better. Again, watch that compound magic video if you haven't seen that already, and you can see how that magic really starts to kick in with any kind of returns over 20%. And then if you can swing trade within a retirement account, it's always best to do that, as long as you're profitable and you're following the market ladder. If you're swing trading and you're doing it alone, I wouldn't recommend to do it within a retirement account, because your losses are not tax deductible at that point. And then past performance is not a guarantee of future performance, so that's good. I always have to say that, just to let you know that investing in the stock market is inherently dangerous, so there's no guarantees at any moment in time. All right, thanks for watching, and I hope you've enjoyed this video. That's all I have for today. And as an old Star Wars fan may tell you, may the trades be with us. Thanks a lot. I'll see you next time.